So class, back to itemized deductions, part 2. We left off with interest and moving on to charitable contributions as we go down the Schedule A. So we can deduct cash and non-cash contributions made to qualified charities. If we drive on behalf of the charity, 14 cents a mile, but our time contributed to a charity is never deductible. So we don't get to add up how much it would have been worth if we had done those for real, or not for real, but for pay instead of for charity. That's not how this works. And also, gifts given to individuals are not charitable contributions. Notice it's to qualified charities, not to an individual. So it's a little more complicated if it's non-cash contributions. It's either usually the lesser of the adjusted basis, which is usually what we paid for it, and the fair market value. All right, but special rules apply to ordinary income versus capital gain property. We're going to talk more about the difference between those, but right now that's going to depend on how long we had the asset we're donating. So ordinary income property is produce ordinary income rates. That for us is going to be inventory investments that are held less than a year. That's what we mean by short term. So if we donate that, the deduction is limited to what we paid for the property. So we donate artwork, we paid $1,000 6 months ago, artwork is currently worth $1,800. That seems kind of excessive, but that's the idea. Since we held it only short term, we only get to use $1,000. If it's capital gain, that means it was held long term, over a year. So then we'll be able to deduct the fair market value. However, if it is personal property that's tangible, physical, not used by the charity for exempt purpose, then we're back to what we paid for it. So, Lynn donated land. That's not personal, tangible property. And we've held it for 3 years. So we get to use the $23,000 as the value of our contribution. Donate a painting to a local hospital. This is personal property, tangible, but it was held long term. But that is not going to help us in this case because the property is not going to be used by the hospital to do hospital work. It's going to be sold and the proceeds are going to be used to do hospital work. Therefore, it is not used in the hospital's exempt purpose, and therefore it is limited to what we paid for it, not what it's currently worth. As you see in the next example, all we did is change who we donated it for. Donate the painting to the art museum. They're going to put it on display. They're going to use it for their exempt purpose, and therefore we get to use the full $4,800 fair market value. See, they have quite a bit different deduction based on what the property is and what it's going to be used for by the charity. Now, once you determine the amount, you then have limits based on AGI. Remember, we talked earlier about a lot of things are based on AGI. This is one of them. If you can't deduct it in the current year, you can only carry it over 5 years. It's not unlimited. 5 years isn't that long in some cases, so we need to understand these limits. So if it's cash or non-cash property where the adjusted basis, we use the adjusted basis to what we gave, who we gave it to, 50% of AGI. That's half of our income. That's quite a bit. That's a pretty high limit. Goes down if you are giving appreciated property or the fair market value. So if you gave stock to a public charity, then it's limited to 30% of the AGI. So you can always elect to deduct only the adjusted basis, only what we originally paid, and then you can go up to 50%. But then if it's significantly higher in value, you're going to get a much smaller deduction, even though you get to use the 50% limit rather than the 30% limit. So there's a choice here that you need to consider with the taxpayer. So donates a painting to the Art Museum, $2,000. It's currently worth $4,800. Deduction is $4,800. However, the 30% AGI limit will apply to this donation because he's using the fair market value. This is tangible property, okay, given to a qualified charity. So there's a 30% AGI limit. Or they could use the 50% AGI limit, but they're stuck with only the $2,000 adjusted basis. All right, so depending on what the AGI is, this would be a much reduced deduction. All of that goes on this section here on the Schedule A. Casualties and theft. Notice that the definition must be sudden, unexpected. Things like termite damage is not considered a casualty. All right, it could happen because of an accident, flood, fire, theft, all those kind of things. All right. So the amount that we're going to deduct is on a personal use property. And this could be on any property. It doesn't have to be a business or anything. Just any personal property. Is difference between the fair market value before and after the event. So it was worth $4,000 before the flood, and it's only worth $1,000 after the flood. So your loss would be $3,000. But it can never be, the loss can never be more than what you originally paid for it. And then you have to, under the tax law, report it to the insurance company. And if the insurance company pays you something, that's subtracted from your loss. So if you had the property that was worth $4,000 before, $1,000 after, your loss is $3,000, but the insurance pays you $2,000, that means your actual loss, your actual casualty is only $1,000. Every personal casualty or theft event is reduced by a $100 floor, sometimes referred to as a deductible. So if your loss was $1,000, no matter what it is, it's always going to be reduced by $100, so it'll only be $900. And then, of course, you have a floor similar to medical expenses in that these are only deductible by the amount they go over your 10% of AGI. So that has to be a pretty significant casualty or theft for it to be deductible. Otherwise, it's not going to be over your 10% of AGI, or your AGI has to be very low. Okay? All of this stuff is calculated on Form 4684, and the amount is carried here to Schedule A. Now, something that's often forgotten by students is there's a reduction of itemized deductions if you have higher AGI. It's 3% of the amount go over the threshold, but can never be more than 80%. So no matter how high your income is, you can never have less than 20% of your itemized deductions. So that threshold varies by filing status. We've seen these thresholds before. They're the same as we used to phase out our personal exemptions back in Chapter 1. You see those here. Example, here we have our itemized deductions. We've applied the various floors for miscellaneous and so forth, and they've kind of skipped ahead in that you have to look at all your itemized deductions with this, even though we haven't talked about a couple of them. We left those for Chapter 6. But trust me, there are more, and they all have to be part of this. So this is your itemized deductions before any reduction. Then you look at their AGI, you compare it to the threshold, take the difference and the amount that they're over times 3% is the reduction. Can never be more than 80% of the itemized deductions. All right, so instead of 59,520, which is the added up amount, they're going to be 56,050 because that's 59,520 minus the reduction. All right, and there's a question on the return, the actual form, that asks you yes or no, is your AGI higher than the threshold? If you check yes, then what's going to happen is when you add up all of your itemized deductions, they're not going to equal this because you're going to calculate the reduction and then put the result after the reduction right here. There's not a separate line to take the reduction off, which probably would make it a little easier to understand. You just won't have this won't total to the bottom because you'll have taken out the reduction. All right, so if you looked at this carefully, this says that there's a reduction in here. You don't see the amount of the reduction or anything. You just see that these four amounts of itemized deduction don't add to this.